Okay. So
Okay.
I assume you'll edit out the start of all of these?
Yeah. So my name is Druv, and I am here to introduce Liz Lamond, who is an expert in the whole life world. And this is a series of videos that I've always wanted to do and record, explaining certain financial concepts that will be useful to the educated investor. Um, I have a goal of eradicating physician financial illiteracy, and this is a recording of those videos as we go along. So that's me, Liz.
Thanks. Yeah, I'm Liz Lamond. I work in the space of whole life insurance. I'm a licensed advisor with Coley Canada, and I also am an authorized infinite banking practitioner. So that means that I've done additional training to understand how to apply this strategy that we're going to speak about today. And I also live what I speak. So I use this in my own life. I use this for my family. I love to talk to people about what I'm doing. Yeah, certainly practice what I preach. And it's certainly made a huge difference to my financial future. And my passion is to share that with others because we're given a lot of misinformation. And by just changing how we're using our money, we can really create very different results. And so, I'm inspired by what Druv is doing too, based on my experience previously in the health sector and seeing people in situations after earning large incomes where they had little left in the later parts of their lives. And just through education, that could have been quite different. So I'm inspired to provide this information as well so that future generations can have a different outcome for their own future for themselves and their families.
Yeah, perfect. Thanks a lot, Liz. Yeah, for the introduction, and let's get started.
So I love this quote by Robert Kiyosaki, which is it's not about how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. So I've done a lot of night shifts and I know how hard I'm working and how I feel when that's happening. And so part of that is understanding that I want my money working for me, regardless of whether I have the capacity to do anything else in that 24-hour period. And I also want it working as hard as I am. So something,
Before we move ahead, Liz,
yeah.
what was your previous vocation?
I was previously working as a social worker in the health sector
Okay.
prior to doing this. And so I was working with people in all sorts of different circumstances.
And what made you pick this particular profession now?
Yeah, that's a great question. So previously, I would see people be limited by choices with their healthcare or their circumstances based on their access to money. So I've always had an interest in teaching people better money strategies, but I didn't want to teach something that couldn't apply to people regardless of where they're at. So when I came across this concept, I was investing myself in real estate, but I was feeling like there was a missing piece, and so once I found that missing piece that really has changed my own experience with investing in real estate, then I wanted to share that with others and I like this strategy because you can start, there's a broad range of the ages that you can start this at. It's going to change your result, obviously. And also the amount that you can put into this is related to where you're at with your level of savings. So I have people who put small amounts in through to very large amounts and anywhere in between. And so we can customize this for where people are at. So, and still create different results for them.
Right. Yeah, essentially you kind of have like an epiphany, right? When you're educating yourself on finances
Mm.
and you kind of have an epiphany and over time you want to record that epiphany because it
Hmm.
kind of either lives or dies with you and all the people that you come in across with, it may help them as well, but there's a level of am I do I know enough, can I pass this information along? And so and that's that's why I wanted to create these videos so that um one can choose for themselves whether they want to educate themselves about this particular um, philosophy.
Yeah, absolutely. And certainly the principles that I was teaching people and what I was doing previously and what I like teaching now is about you having control of your situation. So that's the other thing I really like about this process is it gives back control to the person, the individual. So they can choose to take this information and use it in their own life or not. But also when they're implementing this, the difference is going to be made by how they choose to implement it, and it's not subject to other people's. Like the contracts are going to happen as they happen, but the thing that's going to make the biggest difference is people using the process and following the process. So that's something I really like, that empowerment that comes from that as well is really important to me.
Perfect.
Mm. So something that takes a while for people to sort of wrap their head around that we're just going to start with is that considering that we're always dealing with borrowed money. So we're either borrowing money and paying interest to somebody else, or we're using our own money and giving up interest we could have earned. So most people, when they think about cash, they're not thinking about the fact that they're basically borrowing from themselves, or that they're giving up the interest that they could have earned if they weren't spending that money on the good or service that they're purchasing. Either way, though, it's involving a transfer of money away from you and your family. So when we talk about this, we talk about like opportunity cost. What does that really mean? So for example, if you were spending just over $2,000 a month on living, so $25,000 in a year. So if we just consider 1 year's worth of expenses, if you could live, I live in part of Canada, it'd be very hard to live on just $2,000 a month. But if you could live just on $2,000 a month or just over, if that money is gone from you if you just spend cash. So what do I mean by that? So if you could earn 8% on that money, or if you were to invest it instead, and you were to invest it over 30 years, then the actual true gone money that you've lost by spending that money just directly as cash is actually close to $250,000. So understanding that most people spend a lot more than that every year, and that it's going to compound over time because it's multiple years that you're spending that money. So we're actually in the, millions and millions of dollars that are gone from the interest that you could have been earning. And so this helps understand why people aren't going forward at the rate that they want to, because it's the efficiency around how their cash is used, because they're giving up the opportunity of that money to do anything more for them than the one task of buying those goods or services. So this is what we want to talk about today is how do we change that? How do we make this process more efficient? And how do we get to leverage that cash so that we're not having that high opportunity cost going forward? So I wanted to talk about the different structures that most people are aware of. And I know that in Drew's course, he's going through this in more detail, but I just wanted to talk and I just wanted to list them out simply because generally people aren't aware sometimes of some of those different ways. So you have a bank account. Some people will store money in their house, for example, and then use a line of credit to leverage money against the capital in their house. You might use a tax-free savings account or a Roth IRA in the US. You may use some kind of registered product like an RRSP in Canada or 401k in the US. You also have education savings plans that are registered. So these are the ways that people typically know about where you can store money. But another place that you can store money is a participating dividend-paying whole life insurance policy. And that's less well known. It has been available in North America since the 1870s. So it's been available for a very long time, but it hasn't been well known until more recently that this was a way that you could store and use money. So we're only going to focus on one of the buckets today, and that's the PAR whole life insurance policy, and specifically for corporations as well. So the components of a participating dividend paying whole life insurance policy is what we're going to go through now. So participating means that you, or as the business owner of your policy, have benefits from the participation in that policy. Your policy is paid dividends. It's in place for the whole of your life. So many people are aware of term insurance. Term insurance is generally for a period of time. So 10 or 20 years are the most common. And then when that term expires, to renew it, it's either more expensive, or people just let that drop off. So it's not in place for the whole of their life. Whereas this, no matter how much you age, the premiums don't change, and regardless of the change in your health as well, and it is in place for the whole of your life. So you have that certainty that it will be there. It provides a tax-free estate benefit for your beneficiaries, and it's bound by contractual guarantees. So, what is it about this particular kind of policy that might be different to some of the policies you've come across? So, there are different types of whole life policies. And so, there's some important components, which is why I want to go through them today, because I want to sort of emphasize that not all whole life policies are created equally. And it's really important that you get a correctly structured policy. So, an important component is that the amount you deposit stays the same for the whole of your life, and doesn't and will not increase as you age, and that the cash values grow immediately. Now, this is a really important part, and I'm actually going to show you a little bit later on what I mean by that. But it's important that the cash values grow immediately and cannot go down. So there are some products that people have been using out there where that is not part of the contract. So that's a really important thing to look for, that feature of the product. You need to have guaranteed growth and access to policy loans without qualification. And I'll go in more detail what I mean by that a little bit later. It's private, which is, as an investor, is really nice because I don't have to declare it with my debt service ratios that I have a policy loan. If I don't want to, it's credit protected and it's not subject to market volatility. So really important components. It's super easy to manage, and it's tax advantaged or tax free, depending on how it's used. Anything you want to comment on there, Druv?
Yeah, so I just wanted to access to policy loans without qualification. Is the policy loan directly from the insurance company or from the bank or?
Yeah, so that's a really good point. So when I'm speaking about policy loans, and I'm going to draw the distinction here, if I'm speaking about a policy loan, it's directly from the insurance carrier where your policy is held. If I'm talking about a different kind of loan, that would be a collateralized loan.
Okay.
And then there are qualifications because that is with a third party lender, such as a bank. But the contractual guarantees for the policy loans relate specifically to the loans through using the insurance carrier.
Okay, perfect. And then uh, I guess just a caveat around private. eh, We don't have to disclose loans that are private. However, I suppose depending on your relationship with the banker or your banker or one's banker, it is advisable to let them know about private loans so that they are aware of all the liabilities, I guess, on your file. But yeah,
Yes,
having said that, it's not something that shows up on a credit report, um,
that's right.
and that's beneficial um, for a number of reasons.
Yeah, for sure. Yeah. Just gives you more access to liquidity, should you need it,
Yeah.
which is helpful within a shorter time frame. But yes, absolutely, it's important to have a good relationship with your banker and disclose everything that you need to.
Yes.
So why would we do this versus, so we're talking about different buckets of storage, and so we're looking at if someone was to put $25,000 a year in for over a period of 20 years, into an investment where they're earning 8%. So that's what that blue line is that you can see there. So that's what would happen. You put it in for 20 years, and then over the next 10 years, you just leave it sit. It's not earning any more money. It's just sitting there until you're ready to spend the money. Well, what does that do, right? What does that do for you? That's sort of the line that it creates. You're going to end up with more than what you've put in, which is great. And when I did the numbers that fed this graph, I did take, the taxes that you would pay off this. So that's why it's not not as big as it might otherwise be, but you're going to be above what you've put into it, which is great. So understanding that when we're talking about, and the reason that I wanted to use this graph is that using the dividend paying participating whole life policy, it's an and asset. It's something we're doing in addition to our investment activities. The policy itself is not an investment, and we never want to look at it that way, right? And to be really clear about that, that's why I showed the buckets at the start. We don't think of a savings account or a TFSA as the investment itself. It's the bucket that you hold it in. You need to do something with the money inside a tax-free savings account, such that it will grow. So we want to think about our insurance policy the same way, where it's the bucket that we're holding money, and then we're still going to go and invest. So if we were to do that, that's what the orange line shows. What difference would it make is, instead of just taking cash every year, putting 25,000 down as the blue line is, and investing that at 8%, that's the result. If we were to flow it through a whole life policy first, and then take the money, the cash value that's available, and go and invest it at that 8%, where would we end up? So I want to sort of draw your attention to the first 20 years, which is really important, is that you can see that that gap starts to widen. And the reason that happens is because your money stays inside the policy and continues to compound. You're borrowing the insurance company's money to go and invest. So the differential in the result that you're getting here is that your money's doing effectively two tasks at the same time. It's inside the policy compounding, and now you're using OPM or other people's money to invest. So that's why your results start to widen in terms of the result that you create, because even in the early years, it's going to be even just slightly less, but then it's going to accelerate beyond it, because you've now got more money every year because of the growth inside the policy that you can take out and invest, than if you're just putting the 25,000 in. So important to know about how the design works is that you're actually going to have access to a lot more once we get past that critical tipping point than what you've been putting in each year. The other really interesting thing that I want to highlight on this graph is, if you stop at year 20, so we're not putting any more money into either the blue line or the orange line, the policy continues to grow and compound, because your money continues to compound inside that policy. So that growth that you see there is just purely the policy. So in both cases, I didn't keep investing past 20 years. So understand that this is not increasing during those other 10 years while the money's sitting there, but this continues to increase because of how the contract is structured. Now, something that we often don't like to talk about very much, Drew, but is like, what happens if something happens to us during this time, right? It's not a popular topic, but something that I just want to talk about is this grey line represents the death benefit that is also part of the equation with the orange line, but is not available with the blue line. So if we're just investing cash, that's it. So if we were to pass away, say after 13 years, our family would just get whatever our balance had grown to at this point and nothing more. If we were to pass away, though, and we had this other structure in place, we're already starting to get ahead in terms of the difference in growth here. Plus, our family would get the difference here in terms of the death benefit that comes out to them. So in terms of providing that protection for your family and making sure they're okay and can be made whole on whatever assets that you have, so that they can continue to live the lifestyle that you want them to, then you're providing those both. And that's the real powerful part of this tool that we don't often speak about. We focus on the cash value, but that is an important component that we don't want to miss.
I wanted to cover, does this include the interest you would pay on borrowing within the whole life, or no?
I took that off, yes.
Okay, so it's taking into account the interest one would pay when investing the funds after having taken from whole life.
Correct.
Okay. I mean, obviously, I think we'll get to that at the later parts. The interest rate is set by the insurance company, once a year, so it makes planning a little bit easier. It also doesn't fluctuate, even if the prime rates are going up, like what we have right now. I mean, they
So
do
yeah,
change.
there's just probably a caveat to that, is there are some insurance carriers who are subject to prime rate, so
Okay.
it will change. So it depends on the insurance company that you're with.
So because it can be either I mean, they're all variable, is my understanding,
That's right. Yeah.
but
With
they're
some
not
insurance
variable
carriers,
in
you'll
the
know
sense that
once a
they're
year.
prime
Yeah.
plus
Yeah.
something day to day. It's set once a year. and then it
Yes,
changes from year to year.
that's right. Yeah,
Yeah.
yeah.
Okay.
So I'm talking about like why you would do this. So your business is operating and you're sending money, you're doing exactly what the banks do in terms of how they flow money. So they receive deposits from people when you're putting money in from your income or whatever else, and then they send it out in terms of mortgage payments. We want to create the same with our own system. So this is all that we're talking about doing, is creating an efficient system where our money is moving multiple times. So your high cash value account is going to be equivalent to what the bank is doing. You're going to have deposits coming from your investments into that. You're going to pay premiums probably out of your income. And then you're going to take loans for either your business expenses or you're investing, whatever you're doing. Either way, you can take loans against whatever you need to do, whether it's operating your business or whether it's for investing and creating more income. And then that money's going to flow back in. So we're going to teach you how to get that money flowing. And being an honest banker, you need that money to keep flowing back. So you can choose when you pay that money back, but understanding we want that flow to keep going so that you're repaying the loans. There is interest to pay, obviously, on that. And then that money is then available again because there's growth that's happened inside the policy, like we showed back on the other example with the graph. And then you're going to take that out and redeploy that into the next investment or whatever else that you're doing each time. So let's talk a little bit about owning a whole life policy corporately. So as you know, Druv, you can own it personally or you can own it corporately. So I thought we would just look at an example of somebody who's earning $400,000 a year in terms of income. And I assumed that money was going into a corporate structure
Yeah.
where they're paying a lower tax rate. So just for the purposes of the example, this would still work if you did this personally, but obviously you'd be paying more in tax. So we'd probably have less available. We sort of talked about that, you would need money to come out of that 400,000 for living and all your expenses. And I assumed that what's left over each year is $150,000, right? That's what's available of what you can invest and do something else with. And if we looked at sort of a working career of about 30 years, earning this sort of income level and getting about 4% return. So obviously I could pick any number here. But
I
in
think
terms of
4% is very conservative. I
yeah,
would say 8% is on the higher end, but 4% is quite,
it is
yeah.
quite conservative.
That's actually my underwriting. I underwrite 3.5%, 4%.
Yeah. So if we assume 4%, because there will be fluctuations in terms of sometimes people will earn 15, 20%, other times they'll earn 2%. So we picked a number. It doesn't, for the purposes of this example, it doesn't really actually matter what that percentage is because it'll come out pretty much the same. So if we're earning 4% consistently on 150,000 and having that available every year for 30 years, at the end of the 30-year period, we're going to have about 4.6 million that we've accumulated. So I didn't take money off. I assumed money had already come off for taxes. I didn't actually take money off. I didn't go through all the different derivations of all of that. But just sort of broad figures is what we're looking at here. And so if we were to have the same quality of life of what we were spending while we were working, then that nest egg of 4.6 million is going to last about 15 years. So that's assuming
you're looking at 250,000?
The 150,000. Oh,
Because
sorry.
that's available inside the corporation.
If someone spent around 200,000, yeah.
Okay, yeah. So someone is like including the taxes, someone is spending about 250,000. 150,000 is left inside the corporation.
Mm-hmm.
And now we're flipping it because the savings or the nest egg has to now supply you at a cash income of 250,000. Now, in 30 years, inflation will make. I think it will be very
Yeah.
difficult to spend that
Yeah.
much, but Okay, let's assume that they want to maintain that lifestyle of 250,000. Yeah,
Yes.
in 15
Yeah.
years you would be out of
Yeah,
money
and
even
really
at
good point.
4%.
Like I didn't factor in inflation or any of those things. I was
Yeah,
like, I mean, it's on the comparison still works because I didn't do it for either. But it's like the issue is that that's probably only going to last about 15 years. So
yeah,
a 35-year-old is going to have through till about 80, and then their money's run out with that accumulation using cash strategy, right? Now, this is also assuming that nobody's done any other investing except 4% return on your money. And if you've done your course, Druv, you're going to assume that you're doing some other investing as well.
yeah.
But
I'm
but
hoping, but let's say for the sake of argument that they, I mean that it's an important number to know because of the guarantees that the whole life insurance provides. Rather than seeing that, okay, I need other investments, I just put a large volume through whole life that would double that number, right? The nest
yes,
egg will now
exactly.
last 30 years as opposed to 15 because I just have to put more volume through the whole life policy,
That's right.
which is a strategy.
That's right.
One does not necessarily have to pick that, but that is the downside of getting a 4% return without doing any investing. But
That's right.
these are parameters that people have to think about. But yeah, like I would say, this is the reason why most governments and organizations would say that you're going to go to a lower tax bracket and you need to live at a downsize your lifestyle, um, which is interesting to say, difficult to do, I would say. But yeah, if you don't downsize your lifestyle, then you have about 15 years. I mean, if you downsize from 250,000 to 125,000, then I suppose one could survive for 30 years, which is reasonable. But then that's the planning that someone has to take into account, right?
Yeah, and I think that strategy doesn't really work because generally people, if you look at when people spend the majority of their money, they usually spend it at the start of their retirement when they're traveling and whatever else, and in the
Yeah,
last sort of 5, 10 years of their life as well, when they're needing additional care or services. And if I don't have to tell anybody who's in healthcare who's watching this to know how that works and what that looks like and why you're spending all that extra money. The other thing is that we haven't taken inflation into account here. So
yeah,
even if you were to put that money in half, it probably still wouldn't last you double the time if we just factor into what's going to be inflation in 30 years time. So that kind of strategy doesn't really work for people. It used to work when people had very short periods of life
yeah.
following retirement, right? That's what that strategy was designed for. And unfortunately, that doesn't really work out so well. So if we were to instead flow this $150,000 through the whole life policy for that 30 years, we still have access to liquidity, and we're going to sort of break that down as to how that works. And you will have accumulated around 9.4 million instead. So the important thing to understand here is that the same number of dollars have gone in each case, right? So we haven't changed the amount that's gone into what we're doing over the 30 years. In both cases, it's $150,000 for 30 years. But the difference of what we've created based on the tool and the place we've chosen to store it is enormous in terms of what's available. And that's just where we get to at 30 years. And the reason that I could say that your nest egg lasts a lifetime is that that money continues to compound and grow. Even if you're using loans out and spending that money for the last period of your life, you're not at danger of running out of money in the way that you are, in the same way that you are with just that accumulate a big pile of cash and spend that slowly, because you have an asset that's continuing to grow. So, and then if you were to pass away and I just did life expectancy there, then your family would still receive, even though you would have been spending money out at the same rate during your retirement, what's left over is still 5.1 million. So it's very, very powerful if you consider what you've actually created in terms of what you can spend during your lifetime and then what you can pass on to the next generation as well.
So the right side of the equation is still including 250,000 as the lifestyle expenses.
Correct.
Okay, and what are we taking as the cash value growth? Like 3, 4%?
So I just based it on numbers from an actual illustration from the carrier. Yeah, based
Oh, so
on
so it's dividend scale, not dividend scale minus one.
No, it's just the
Okay.
current dividend scale. Yeah.
Yeah.
So let's talk and just kind of, I really like this diagram about why we used a corporate strategy. Like I said, you can put a policy, either personally or corporately, but there are some advantages to having in a corporation. So, as owning it personally, you still get policy loans either way. So that doesn't change and you've got opportunity for further growth. But if you put in a corporation, your money's taxed at corporate rates before it goes into the policy. So obviously there's more cash available to put into a policy. Either way, there's no tax on growth, and either way, it's tax-free on death. Something that's very not really well known is the capital dividend account. So that's what allows proceeds to come out tax-free from the corporation when the life insured passes away. And this is a very, very powerful component, available only in Canada, though. They don't have this equivalent in the US right now. This is something unique to Canadian business owners. And this enables that money to come out of the corporation tax-free. And the power of it is, if we talked about our previous example where you're spending down that money during your retirement, the capital dividend account is actually going to be not for the amount that's left, like that 5.1 million, but the full amount of the death benefit, not taking into account. So that means that there's going to be additional room for other assets to come out of that corporation tax-free if a person passes away at sort of life expectancy. So in terms of asset planning, if you're investing in other assets like real estate, or you have other cash built up in your corporation, it's a unique part of the tax code that enables you to take your family and beneficiaries to take more out of that corporation without attracting tax. Now, I'm not an accountant. I'm not providing tax advice here, but it's a very powerful strategy, and it's something that I would encourage you to investigate further, because if you're building additional assets, particularly corporately, it's a very powerful way to pass those assets on to the next generation and have those benefits, so that it's not sort of all lost in the taxes that would be due on those assets. So let's look at an actual policy. So I decided to use an example of putting $50,000 into a policy for 15 years. So a little bit different than what we looked at before. But just sort of, if we started at age 35 and at age 50, we said, that's it, we're not putting any more money into a policy. So you're not sure where you're up to in your working career at that point, and you just want the policy to be efficient on its own. So over those 15 years, you've put in $750,000. So what we're showing here is the premiums in here is on the left under cash premiums. This is the amount that the insurance company will pay with the current dividend scale to sort of boost your policy. But putting this premium in every year for 15 years, this is the cash value that you can borrow against. So we'll talk in more detail about policy loans in a moment, but just to understand that you can borrow 90% of this number from the insurance company. So like we talked about, this is a tool where you're storing money, but then you're wanting to use that money to leverage to buy more assets. So we've spoken about how to do that in different ways. So in those early years, it's important to see that you're going to have a little bit less available than what you've put in if you're using strictly policy loans. But then it starts to tip over where you're going to that cash is going to break even and start to be more available than what you've put in. So if we look at the 15-year point, we've put in $750,000, but we have over $1 million available. So there's significantly more available than what you've put into this policy, and you haven't lost access to liquidity for those 15 years. So likely you've grown your wealth much higher than this because you've been able to invest in other assets as well. And then we have the death benefit here on the side, where you can see that what would be available to your beneficiary should you pass away. So the reason that we want the death benefit to continue to grow, you can see the death benefit started at 1.2, and we're going to talk about this. The reason that you want that to grow so much is because of the contractual guarantee. This is why this type of policy grows, is a contractual guarantee that the cash value and death benefit must be the same number by age 100. So while it's important to have protection for our families, and it's 120 in the US, while it's important to have protection for our families, it's also really important to understand that the higher we grow the death benefit, the higher the cash grows. And what we're really interested in is what can we spend during our lifetime. So as you can see, this policy, even though we've put no more in than 750,000, by sort of retirement age, we've got almost 2 million available. And then as we spoke about earlier, that number continues to grow despite not putting more money in, up to having sort of $7.5 million available by age 100. So that's a growing asset that you can continue to draw down on and still have money left over for your, loved ones if you were to pass away during that time. Any
So
comments, Drew?
so looking at this at 865, you have at the current dividend scale, you have approximately 2 million. So just rough numbers. So if you were to have a lifestyle of 250,000, which I mean, I wouldn't recommend it, but let's say one does, you're talking about 8 to 10 years, less than that, about eight to 10 years before you hit the total cash value. But in the 8 to 10 year mark, you would be further ahead where the cash value would grow. So you would get about that many years. I mean,
That's
this
right,
would
because
not sustain your retirement. This wouldn't
that's right,
sustain
because
your
over the next
retirement.
20 years, it's growing by another like 2.3 million.
Yeah,
So because that continues to grow, that's why you can continue to sustain that level of drawdown on your money.
yeah. And then if let's say one does completely use the total cash value, so let's say by age 85, I used up 4 million.
Hmm.
Um, there would be interest payments on that. But
Yes.
despite that, at the time of your passing, let's say soon after 85, the family would still receive 5 minus 4, 1 million still,
Yeah, they'd still get
living
approximately
a
$1 million. Yeah,
reasonable lifestyle. I mean, they're living a reasonable lifestyle for that period of time. And I think that's where the power of a corporate owned whole life policy is. Um, if one can get past the high premiums, if one believes that they're paying that. Also, this cash premium, I mean, there's a component of guaranteed premium, right? Which
that's right. Yes,
is so if there is a difficult year, let's say like COVID for physicians, where surgeries are not being done
hmm,
and one cannot meet, I wouldn't say the obligation, but the requirement to fully fund the policy to the full cash premium, I would think that if I would think it would be about 5 to 10,000 to keep the policy alive. I would keep the policy alive even though it provides no cash value benefit to me much, just to be able to ride the difficult years in order to reach this overall goal at age 65.
that's right. Yeah. Yeah. So you have a lot of flexibility in terms of those premiums. Like we spoke about, the number of years that you fund the premium is going to change the result. But the nice thing is you do have that flexibility, such that if your income changes, you can keep the policy in place if it's not at the stage where the policy is sufficient on its own. So, like in this example, at age 51, the person could put in more money, but could also choose not to, which is what I've illustrated. So then it becomes a non-issue. But if that happened in those first 15 years, there would absolutely be flexibility in terms of putting in that minimum required premium, and then just sort of riding out that time. And the growth would be lower than what we've illustrated here, but you would still get all the benefits of what you've done to up to that point, and then what you did from that point onwards as well. So,
Yeah. Now,
yeah,
if
for
one
sure.
wants to deposit past age 50 to 51, my understanding is you would have to get uh, like reevaluated in terms of your health.
No, so it depends how the policy is designed, but
Yes.
in the way that I tend to design them, I'm not going to set that parameter for people generally. At that point, I'm going to give people the flexibility as to how long they want to continue to fund the policy for.
So you have something like extra deposit option uh, of 750,000 over one's lifetime with regards to this policy.
Yes, it would be, yeah, depending on the carrier that we go with will
Yes.
depend how it's designed. But yes, so there would be either the option to put in more deposits or more base premium as well. or to stop putting that in. They'd have the flexibility to do that. So I use these numbers are direct from one of the carriers, and this is,
Yes.
I could have kept putting money in, but I chose to cut it off at 15 years.
Yeah, I mean, 30 years is a very long time, I must say. Um, so it's in my mind like a 10 pay or 15 years
That's right.
seems like a reasonable uh, thing to wrap your mind around, like to
Exactly.
especially when you have high numbers. Let's say the previous one that we discussed, 150,000, 150,000 for 30 years. I mean, it seemed daunting to me.
Yeah.
Still seems daunting to me, um, especially in the advent of COVID, because of the lack of surgeries. Their income actually did go down. I
Hmm.
mean, some physicians' income increased, but most physicians' income may have gone down. And so now you've, they used to say physician is a recession-proof job. Well, clearly it's not a recession-proof job. There was fluctuation in the income, which made it difficult to save for retirement. And that's where, you know, um, I would say it helped me learn a lot about the flexibilities that are possible within the policy.
Hmm.
Um, and so it's important to understand that one does not have to put in that amount, and that's where the design comes in because
It does, yeah. Because some
um
policies are not designed to give you that
yes,
level of flexibility. And it's actually really important because it's very hard for anyone to predict what could happen over the next 10 or 15 years, even if you're only
yes,
designing it for that period of time. So it's important to have that level of flexibility so that you don't lose the momentum of what you've created to that point.
yeah,
And also to understand, and this is where this conversation, I'm going to keep bringing it back to buckets and storage, is like thinking about what is the money that you're flowing through your life anyway, and how can we flow it more efficiently. So thinking about it less as a premium payment and thinking about what am I flowing through my life and putting into savings or investing anyway, how can I flow that more efficiently. So when we think of it that way, it's like this money is going to flow through your life regardless, because you're going to have to live, you're going to probably want to do some investing. So how can we flow it through a tool that's more efficient to create the results that we're talking about? And that's a really important part of this, because like you pointed out, Drew, like this, in this example, this person has only put in $750,000 ever into this policy, but they created, approximately 4 million that they spent during their retirement years, and then still had 1 million left over for their family. Like that's
yeah,
amazing. Like in terms of like money in to money out, like if that money was flowing through their life anyway and they just put it through this tool, the efficiency of that is amazing, and we assume that the results would be even better were they to invest that as well.
yeah. Like, I mean, I think that this is the main point that I would say that people have difficulty wrapping their mind around is there are other tools available to achieve this,
Hmm.
but um I mean, this is where a little bit of mindset, comes in, and I talk about this a little in my course. Is that let's say we have a patient who has cancer. I mean, patients they want to have a general idea that I'm cancer free. They're looking for an outcome. They, I would say, I mean, obviously depends on the patient, but I would say patients are not interested in knowing that, this chemo drug gives me an extra 5 years compared to the next chemo drug, which doesn't give me as much 5 years, but it has more side effects. Like, I mean, most patients want to have a feeling of being cancer free. It's a feeling. And so because these whole life policies are contracts, they give you the feeling of more certainty. I mean, I don't want to use the word guaranteed or certainty, but
Mm-hmm.
they give you the feeling of more certainty of one's ability to survive retirement
Hmm.
and pass on a legacy to um, their estate or to their family. And so while other tools may give me more capital, they don't give me that feeling. And because we are emotional human beings, um, and our decisions are not always rational. Sometimes, this is just me. I would choose a more certain path, rather than the highest return path. And I think that
Mm,
that was another, epiphany as well,
mm,
because any tool that gets me closer to the goal that I want is a tool that I would rather use than a tool that, you know, has probabilities associated with it, because we're not good as humans in determining probabilities.
mhm. Yeah, and using this as a foundational asset, right? So not we're not saying don't do other things. We're just saying use this as a foundational asset so you have that feeling that you have multiple strategies in place where your money is working for you. And I think the really important part of that is a lot of people reach a point in their career where they start to ask, how much longer do I really want to work for?
Yeah.
And don't necessarily want that prescribed that that has to be a certain age. So, for example, with a registered product at the moment at 71, somebody has to start drawing money out
Yes.
at that age, and that may not actually suit your financial situation the best at that age. And so, having strategies in your tool belt that you can choose when you use them. So there's no. I mean, I've shown the example at age 65, but somebody wanted to start taking passive income at age 60, they could absolutely do that, or 58 or 59. Like giving yourself that flexibility so that you get to choose how you use this and when you use this in conjunction with the other assets that you've built is also a really important part of that sort of mindset piece as well, I think, Druv, so that people have options. Because I see people in real estate get sort of trapped with equity in different pieces of real estate that they can't necessarily access in the same way, which would matter less if they had other capital that they could access at the same time. So it's like, what are the complementary tools that you can use together to create the result that you want so that you can choose when and how you use that capital?
Yeah. I would say that the one extra caveat here is, um oh, yes, we could say that, you have a whole life policy and do the thing that you would normally do with that capital, where you're just flowing it through a whole life policy. I would say that, I would recommend a little bit of planning, because
Oh,
if
absolutely.
because if, at the end of the day, it is borrowed money, and so if the money can't be returned back, then it becomes a bit difficult, because there are tax consequences to canceling a policy, like,
Hmm.
well into the future,
Hmm.
which um, which yeah, which has consequences. Like, for example, if you were to cancel the policy at age 65, well, depending on the adjusted cost basis that was covered in the previous flu slides, and again, this is not a comprehensive covering on that. Technically, there has been a growth, so to speak, of, close to 2 million from putting in $750,000. So there's tax consequences on, that growth, whatever it is, whether it's whole taxable income or capital gains or whatever. There's that's that
Hmm.
tax consequences on that. And so, um, if one has borrowed that value and is unable to put it back into the whole life at some point, to reuse it at some point, then it kind of literally blows up. I mean, it kind of does sound like blowing up. So it's very important that there's some planning done on, the piece of, um, using the money that you would normally use the capital for. And actually, what I would say for me is it actually made me a better investor, because I'm more risk averse when I take money, or when I borrow money from my whole life policy and do the thing that I was going to do. I do more due diligence on the investment than I would normally do, because I want this investment to perform so that I could fund my whole life back, or repay my whole life back, so that I could actually use what this whole life was designed to do at age 65. So it actually forces me to do more due diligence on the investment than to just say, oh, well, that investment can be a loss. Well, if it's a loss, then I have a borrowed money here that I have to pay back, because the primary objective is to keep this policy alive.
And I think it's also, that's where it comes into the mindset piece is like, it's a loss regardless. Like one should do their due diligence on investments regardless of
Yes.
whether one's
Yes,
flowing it
exactly.
through. Like if it's coming out of a line of a credit or a HELOC, you've still got a hole there to fill. If
Yeah.
it's cash in your bank account, there's a hole to fill in terms of what won't be available for you at retirement. Like there will be loss regardless that we want to, mitigate against. And so that's not unique to this product. Like, yes, absolutely, you completely need to do your due diligence and make sure that you're protecting your capital at all times. That's a
Yeah.
really important part that I speak to people about a lot. Is this is how do you protect your capital? But there are many components to protecting your capital. This is just one. This is just the first part of it that we're talking about today. As you mentioned, there's lots of other ways that you need to protect that capital and make sure that it continues to do what you expect it to do.
Yeah.
So let's talk about the death benefit. Most people are aware of that part of insurance. Now, with term insurance, I'm sure you've all heard the phrase buy term, invest the difference.
Yeah.
Well, the death benefit on a term insurance policy doesn't increase during the period of the policy. So, and the amount that you pay is determined by age and the health status of the insured, right? And every time it's renewed, that premium goes up simply because the closer we get to our mortality, the higher the amount of premium the insurance company needs to collect, because it's getting more and more certain that they're going to have to pay that out. Now, with term insurance, only 2% of term insurance usually gets paid out. 98% of people outlive it, which is great for the people who are outliving it, absolutely. But at the end of the term, you've paid the money, you don't have any cash value left. Like there's no cash value available as a term insurance policy. And your death benefit hasn't increased, and then it's probably in most cases becomes prohibitively expensive at the time you might need it to benefit your family to get that insurance. So most people don't have term, or it's just not available to you to purchase later in life with a lot of insurance companies. So the difference with a correctly designed participating whole life insurance policy is the starting death benefit is usually lower than what you would perhaps look for on a term insurance policy. And it does increase significantly every year that the premium is paid into the policy. So really important to understand is your premium doesn't change even if your health changes or if as you age. The premium that you've started with at the start of that policy, that stays for the length of the policy. As we spoke about, you've got some flexibility to reduce that down, but that doesn't change. So you could still be paying the same premium into your 80s if you really wanted to. And the reason, as I spoke about earlier, that we want that death benefit to continue to increase, which is an important part of the design, is the contractual guarantee that the cash value and death benefit must be the same number by age 100 or 120 in the US. And so the higher we can get that death benefit, the higher we can get the cash that we can spend during our lifetime. So even though we're talking about the death benefit, we're using the cash value is simply a lien against that death benefit. So we want to increase the amount that we can use a lien against. And that's the important part of the death benefit, as well as obviously the protection it's going to provide for our families. So we'll also talk about riders. So a rider is something that there are lots of different types of riders. You can have riders for all sorts of different reasons, but I'm actually only going to focus on one because that would be something that you would speak to your advisor about, what other riders you could add in. And for the purpose of this conversation, it doesn't really help you to understand all of those. It just gets too much detail. So we're going to talk about one of the riders that you can put on, which gives you additional death benefit. So why would we put a rider on? We might put it on because with a whole life policy, typically the amount of insurance we're starting with is lower. So, but you might have a higher need to cover, like if you were to pass away and you have a young family, you might want more insurance in place. But the other benefit that we get from the rider is that it usually gives us more deposit option room in terms of what we can put into the policy. So using the same example of this $50,000 premium that we're planning to put in this policy, we would be able to put up to an additional $40,000 into this policy just by adding this rider. So with understanding the power of compounding, the earlier we put in dollars and the more we put in, the more benefit we get over the long term of that compounding effect. So by putting in extra dollars earlier, if we have them available, the flexibility that if they're not available, we don't need to put them in, can just increase the result that we get. So it can either shorten the timeline. So maybe instead of like the example before where we funded for 15 years, maybe we put more dollars in early years and only want to fund for 10. So we can shorten those timelines. Or it gives us that ability to put in that extra capital, flow it through, and then push it out into whatever our other objectives are. So as you can see, there's you can see in this example, you could put in as a little as 22,000 and you could put up to 90,000. So, and you can see that your death benefit is now increased to 2 million. And when that rider drops off, as you can see here at year 20, the guaranteed death benefit is back to 1 million. But if the premium has been funded during that time, the actual death benefit at that point would be over $5 million. So we're not concerned that the rider is expired. We don't have to pay for a more expensive term insurance because we've got more than enough death benefit at that point. So that's the advantage of how you can use those riders to sort of boost the amount that you have available. Any
And it
questions
also
on that, Drew?
lifts the MTAR line, right? In Canada, the maximum tax
Mm-hmm.
actual reserve, and
Mm-hmm.
then the MEC limit in the US.
That's right, which is
Okay.
why you're able to put in that additional
Yeah.
premium. Yeah. And whether or not you can continue to put that premium in past when that rider drops off will depend on how much has been put in those early years. So in terms of where that line, as you said, gets to by, say, year 10, whether you could continue to fund more if you wanted to. So let's talk about the savings component. So you can use this tool for anything that you want, but if you're already putting money into some kind of savings vehicle, like a registered product, understand that anything that you're saving into a registered product, there may be some benefits as it goes in terms of what you get back. However, any of the growth inside that tool and when you take that money out will be taxed. Whereas putting this into this tool, as long as it's taken out in the right way, you can use that money either tax-free or tax-advantaged. And it must be properly designed for you to benefit from your cash value. So something that I see a little too often, unfortunately, is people who bring policies to me who've been designed by people who don't understand how to design this correctly. So people have thought that they were saving money into one of these structures, but unfortunately, I'll look at the cash value and it might be at like $0 or $1,000, even though they've put in that $50,000 premium. That is unfortunately not a correctly designed policy. And that is not what we want to see. So part of the reason that I wanted to show you this is just to kind of highlight, like, what should you be getting from your cash value? Now, there's going to be some differences in how they're structured across the different carriers that do the correct kind of policy. But just to understand that unless somebody is showing you something that has a very high cash value, this is not the right kind of policy for you. And there are different designs that I do use which have a lower cash value in those early years, but we do use that for a very specific purpose. And it's really important that you understand what it is that you are purchasing. You must understand what it is and what it will do for you in the short term and the long term, because it's very disappointing to not get the result that you expect and for it to not sort of perform in the way, even though you've been diligently paying those premiums. So let's talk a little more about policy loans. So you are contractually guaranteed to be able to take out a policy loan, and it's 90% of the available cash value. Now, question I get a lot is, when can I take out a policy loan? Well, that does depend on the insurance carrier. Some carriers you have to wait until a full year has passed, but quite a number of the carriers you can take a policy loan almost immediately. So that cash value amount is going to be lower than what is shown in this example. The cash value that you see there is what's at the end of the first year, but you can access money straight away. You don't have to provide a reason to have a policy loan. So they literally, on the form that you fill out, or if you phone them, you tell them what amount you want out of your available cash value and where you wanted to deposit it. That's it. And in my experience, for me, just about every single time the money shows up in my bank account within about 3 business days. So it's super simple. And then the insurance company doesn't even ask you when you're going to pay the money back. So why is this important? So for me as an investor, something that I find really helpful is that I don't necessarily want to have to make monthly interest payments back to like I do when I have a line of credit. So I might not have the additional cash flow available to make those monthly interest payments while I'm waiting for that investment to start paying me money back. And I have flexibility when I take a policy loan as to how I do that. So I could choose to wait until I'm starting to get money back from the investment to pay it back, or I could wait sometimes until the end of that investment and put it all back in there. I get to control that and I get to choose how I flow my money. I always encourage and teach people to pay money back into their system when they're in that stage of building up the value. As Druv spoke about earlier, there's some dangers if you're, constantly drawing money out of something and not putting it back in. So I would never encourage anybody to do that. We want to be cycling money back through and making sure that we're protecting that capital. But the flexibility that you have in terms of how you manage that loan is really, really nice. We can also, we spoke about this very briefly, but you can also take a loan by collateralizing the policy with a third party, typically a bank. And we spoke about that. And then the advantage of doing that is that you can usually take a higher amount out sooner. So we have some professionals, investors, business owners who want to be able to access up to sort of 90 to 100% of the premium that they're putting into the policy every year so that there's no lag in their cash flow. And that can be achieved if we collateralize a policy. The downside of taking a collateral policy is the bank does have qualifications, so you will need to go through that. You will be required to make interest payments, so there will be monthly interest payments to make, and there are fees attached to using that kind of strategy. So sometimes it's worth it. Certainly when a couple of years ago, when the bank interest rates were very low, a lot of people were more inclined to use that strategy. Now that the bank interest rates have jumped up, so it's going to depend on all sorts of factors as to whether that's going to work, and it's going to be based individually on what you're wanting to do with that cash as well. So the nice thing is that you do have the flexibility. You can choose what you wish to do. And as an advisor, that's something that I put in place for people is I provide, the collateralized loan. I can set that up for people, as well as if people want to take a policy loan, then that's something I teach them to do, and they can do that very independently. So there's sort of lots of options as to how you would use that. So in this example, this person could access this sort of amount of cash value at these different points. So after 10 years, they've put in $500,000 and they've got access to 90% of $591,000 that they could take as a policy loan. So if they hadn't taken any previous money as policy loans prior to that, that's what they would be available to access, or the difference between what they'd already used as a policy loan and what they'd paid back. And then the reason the insurance company doesn't ask for you to specify when you're going to pay it back is, as you can see here, the policy loan available is $591. The cash value is $591, and so 90% of that. So just say one took out $500,000. One passed away the next day, the beneficiaries get the difference between the two because it's a lien against the death benefit. So the insurance company is not concerned that they're going to get their money back, because they would just pay beneficiaries approximately $2 million minus any interest, of course, it's owing. Another really important part about policy loans is it's simple interest and it compounds on the policy anniversary. So what does that mean? That means that you only pay interest on your interest if you haven't paid that interest part back after your policy anniversary. So in terms of, mortgages tend to be compounding interest. If you sort of the difference, lines of credit tend to be simple interest, but just sort of to understand the difference in terms of when you're doing the calculations of how you use it. And then if you're using a mutual insurance company, then all of the profits of that company come into a pool. So a question that often gets misrepresented in the media is people say, well, I get all my interest straight back to my policy that I'm paying. That's not actually accurate. What happens is that all the interest that everybody who owns this kind of policy is paying comes into a pool with the other profits that are coming into that pool, the insurance company takes out their obligations, and then what's remaining gets distributed to the policy owners as a dividend once a year. So it's not a direct route back to your policy, but there is a component of that activity that you're going to benefit from.
So two questions then, because so in the Canadian space, um, is there a benefit to going with a mutual company or a stock insurance company, or no?
Um, there's less distinction than there is in the US space, for sure. But in terms of interests of how money is used, what the interest of the company is, things like that, there is obviously always going to be competing interests in a stock company. But there is, in either case, there is a what's called a participating pool of money that is available to policyholders that gets distributed as dividends. So, there's it comes down to sort of other factors more so than what in the US is. There's bigger differences.
Okay, because I've always grappled, like I've had difficulty with. I mean, most of the consumption of information for me has been the U.S. Um, when this journey started, I mean, there recently, like yourself, more information is Canadian specific coming out. But this question of going with a mutual company or with a stock company has always been there for me, at least, and I know I mean I still haven't been able to answer it, but um I would say I have a mix. I have a hodgepodge of a mutual and a stock company. Um, Although most of them are stock insurance companies at this point. Um, and only time will tell in terms of that participating account, the general fund, as to how they perform. Um, but I think overall, based on the illustrations, they seem very similar in Canada
Mm,
compared to the US. And also, I think in Canada, we don't have a guarantee rate compared to the US, which has a guarantee of 3 or 4%.
hmm. That's right.
Okay.
Yeah.
Now, the second question is with regards to this total cash value. Let's say you reach the age of 50, so it's been 15 years, and I want to take a policy loan, not a collateralized loan. Do I actually have access to 90% of 1 million because of the adjusted cost basis, or no?
So the cash value that you see there, you would have access to 90% of that. So it's just over $1 million.
So when does the adjusted cost basis come into play?
Um, that's a whole other seminar.
Okay. Okay.
So basically, the adjusted cost base is like a bell curve, and then you've got the line of the growth of the policy. And so once those two cross, and it goes sort of down to zero by age 85. So the answer to that question will depend on the amount of premium that's going in, the age of the person when they took out the insurance, all sorts of factors. So I
Okay.
can't give you a like distinct answer per se, but it's something that does get modeled out. And at that point, when that happens, if you took a policy loan, yes, there could be tax payable on the difference between the adjusted cost base and what you've taken out, not the bit below that. But when you pay it back, you get a tax credit. So if you're recycling money still, you'll get a
Oh,
tax credit when you put that money back into the policy. Um, if you're at the stage of life where you're just taking money out of a policy, you're using policy loans, like we're never going to withdraw money from a policy, but if we're using policy loans for passive income, then there would be a point at which it would be beneficial to use a collateralized loan, and there's a retirement product that the banks offer, such that you don't have to worry about those tax implications.
okay. So if one borrows from the total cash value and it's above the adjusted cost basis, they would pay tax. But then when it is paid back, you get a tax credit for the amount of tax that has been paid.
Hmm.
Oh, well, that still makes policy loans beneficial. I mean, I must say personally from experience, policy loans are amazing. Like the process and filling out a form and just the whole process has been really wonderful with regards to the policy loan, and I can totally understand why they do it on the U.S. side um, compared to a collateralized loan. But having said that, the collateralized loan experience for me also hasn't been bad. It's just that it is the traditional experience of like qualifying for the loan, assets
Mm.
versus liabilities, and one's ability to pay back the loan and so on and so forth, and credit check as well. It's interesting that there's a credit check, but it doesn't. The loan does not show up on a credit report, but the credit check and the fact that the bank did the credit check appears on the credit check,
If you're
which is
taking a collateralized loan, yeah.
yeah, which is interesting because the loan's not on the credit check, but the fact that they checked it is on the credit check.
That's right.
So I found that interesting because like either put everything on or don't put anything on, right? Like, but anyway,
Yeah. And some people don't really understand collateralized loans. So to take it really simply, if you take a loan against your mortgage on your home, right? Like you're effectively using your house as collateral, right?
yeah,
Instead, here, what we're doing is we're using the whole life policy as collateral. So basically, what would happen is if you pass away while you still have this loan out with the bank, is the bank would get the insurance company would write two checks. One would go to pay off whatever you owed on that loan, and then the second check, including interest, and then the second check would be the remaining death benefit that went to your beneficiaries, whoever they are. So
yeah,
it's a very simple. It's very simple in terms of how it works. It's not that complicated, but as you said, it does take the usual qualifications at the front end.
yeah.
But and so a lot of people will end up using policy loans just because they're so simple. Like I've literally taken hundreds of policy loans, and it is super simple, and it's easy to pay them back. It's lovely to see money show up in your bank account, and and
Yeah.
then deploy it wherever you want to. So
I would say if one could take a policy loan, that is, I mean, obviously look into your own situation, but if one could take a policy loan, I would. But I must say that one of the insurance carriers where you have to wait 1 year, 1 year is a long time. It felt like a
mm,
long time when I wanted to collateralize the loan, and so um, and I wanted experience with the collateral loan anyway. But 1 year was a long time before I collateralized the loan, and then eventually when I wanted to shut it down, close the collateral loan, and then take a policy loan after that. So
mm.
and
Yeah, that's right.
nowadays,
So that's
it,
if you're using a carrier where there's a longer wait time to take a policy
yes,
loan, a lot of people will do the collateralized loan because they can do that straight away. Yeah.
yes, yeah. I mean, you
Yeah.
could do it within, depending on the bank, I think like 30 to 60 days, which is as fast as a policy loan with certain insurance carriers.
Yeah, that's right. Yeah. So let's talk about who is this good for? So you can actually put a policy on somebody who is as little as 16 days old. I think the youngest I've done to date is about 20 days old, but yeah, it's certainly available from 16 days old. So
Yeah,
right up to 85 years old. So there's a lot of latitude. So a lot of people who are looking at this often will ask, they're in their 40s or 50s. They're like, "Am I too old for this?" No, you're not. You can start, anywhere in that range. You can have it personally owned or corporately owned, depending on your circumstances and depending where your cash flow is. And that's something your advisor would go through and speak to you about what's going to fit best for you. I actually have both. There's benefits to having both, so you might also do both. Um, Now, everybody gets the benefit of turning cash into capital and creating their own retirement strategy. So I have policies not only on my own life, but I also have policies on my children. So whether they know it or not, I'm building up value for them that they can use later on in their lives. And in that case, because I'm the owner of the policy, I get to choose when I pass those policies on to my kids. And so, they will get the benefit of understanding how I've turned cash into capital for them that they can then use through their lifetime. Um, So, we spoke a little bit about how investors can use it, getting their money working multiple times. So, one of the frustrations for me with investing was when I was doing sort of more of a buy and hold real estate strategy, is that money was locked into that real estate usually for about 12 months. Like, could be sometimes less until I either refinanced the property or sold it. So, that money, while it was creating a return, it was only doing one task at a time, and I want my money doing multiple tasks at a time. So just by changing where I'm flowing my money through, I'm now getting my money to do multiple tasks as I put it into the other investing that I'm doing. One thing that I thought was really important, and I know we've spoken about, Druv, is that professionals are busy, right? So it's very easy for a week to go by, right? So you might be looking into an investment strategy, but but it might take you 2 weeks, or if you're working a lot of night shifts. I know when I did night shifts, I didn't do anything else that day except sleep, eat, and exercise. Like, that was the 24 hours, right? I was working and that was all I was doing. So if my money wasn't doing anything during that time, I was losing a lot of momentum and compounding because my money was doing nothing else. So while you're, doing your due diligence and looking into those other things, as long as your money is in a tool, and this is the feeling part as well, like knowing that your money is growing every day. Like, I can say with absolute certainty that the cash value in my policy is higher today than it was yesterday, and it will be higher tomorrow. And just knowing that means that if I don't get to do anything on whatever else I'm doing with my wealth building today, that's okay, because at least something's happening with my money. So that's a really important component of it. If that's important to you, that you're trying to grow wealth. And then families, I spoke about how I'm using it with my own family. And then that's going to provide tax-free benefits to my beneficiaries. And then we can create multi-generational wealth. So putting this, on grandchildren, children, and sort of future generations is really, really helpful. Oops, sorry, went back. Need to go backwards. So who is this not good for? People looking for a quick solution. So this is not going to work for you if you think this is going to happen quickly. It does take a while for these policies to become efficient, and to have, if we're just speaking about policy loans as we were, you're not going to have access to all the capital you've put in initially, and so you need to be able to navigate through that. It's also not something I'd recommend for people who lack the discipline to put money into a system over a period of time. So if you aren't, we don't ever want to build this that's going to cause stress for people. It needs to be built in an amount. We showed some numbers today, but those were made up numbers of possibilities, but nothing prescriptive. So it does need to be designed specifically for an amount that is going to be realistic for you to put in over a period of time to create a result that you want to create. Now, some people also have health issues that may preclude them from being insured. Now, it is possible to be the owner and put insurance on a family member or anybody else who have an insurable interest, like a business partner or somebody else. So you don't actually have to be the life insured to use this system. But some people don't have anybody else that they can have an insurable interest in. I have come across that as well. And so those people, it unfortunately wouldn't work for. And it's also not good for people who are going to think about this as an investment. It's not. It's a safe place to warehouse your wealth, but it in itself is not an investment. And while obviously what we've talked about gives you a lot of really great growth, I wouldn't recommend that this would be the only thing that you did. You need to do your due diligence on other ways to grow your wealth as well.
Yeah, and I would add, yeah, I mean these are like very good points, and yeah, and that's the thing. Like the purpose of this video is for people to at least have some level of information before you come here, because we are actually, I would say, we're covering kind of mid tier aspects. Like there's the beginner, there's the mid, and then there's the advanced. So we're covering like mid tier concepts here. The
Mm-hmm.
other one that, yeah, who's is not good for is very fluctuating income. So if you have wildly varying income, then it's very good. It's very good at the beginning to have a high cash premium, but then your policy won't perform as well if you're not able to actually kind of meet those numbers. And you
Mm-hmm.
actually, in those individuals, then that's when the buy term and invest the difference strategy may work better. Um,
Or using a policy at a lower level of what they're
yeah, at a
putting
lower
into.
level.
Yeah.
And then the other thing is, I mean, the nature of MPC, so medical professional corporations, is that only a physician is a shareholder in the company, and then the other kind of family members, I forget now, are not shareholders or they're non-voting members. So if a physician, actually, I was recently listening to a podcast where this was in the US, where a physician was diagnosed with a brain tumor, and it was interesting because he asked, what could you have done better? Not done better. What could you have done that maybe had taken care of your family better? And he said, I had a term insurance policy of only a 1 or 2 million. I wish I had taken more insurance because now essentially he's precluded from getting insurance very easily. But can in a corporate owned policy, can you have a corporate owned policy on a non-physician spouse of a physician who has an MPC? Because
Um,
business partners, I know they're both equal partners within the business, so you could do that. But I've always wondered, like, if you have a spouse who's not a physician but part of the corporation, because essentially this money is being used for retirement in the future, can the corporation take a policy on the non-voting member?
so I'm not going to speak specifically because I don't want to be giving corporate
Yeah.
legal or tax advice. That would be something I would encourage people to look into themselves. I'm going to stay in my lane of insurance. What I will say is that what a lot of people do in terms of structure is that they'll have their holding company and their operating company.
Okay.
And so typically they'll put their whole life policies into their holding company. And there may be the spouse is also a partial owner of that holding company.
Okay.
And then there are other corporations, whether they're, the physician
Yeah,
corporation or
that
other
that
types of
that makes
corporation.
total, yeah,
It's
without going too
generally
much
what
into,
people do. Yeah.
yeah, without going too much into details, not, specific advice, again, basic
Yeah.
disclaimer, not tax advice or accounting advice or even insurance
Yeah.
advice. This is educational purposes only. But it
Yeah.
was very interesting when I started out this journey, um, being like, okay, you get proposed as corporate owned policies, but then the corporation that one has in their physician career is, can't utilize that particular aspect, which is if you have health issues that preclude, you can take insurance on an insurable interest, but within that corporation, they're not an insurable interest. They would need, your basic other corporation, or even owning the policy personally, as it was mentioned here. So just a very specific caveat to, corporate owned policy here.
Yeah. Absolutely. So I would recommend that you work with an authorized infinite practitioner. So from the Nelson Nash Institute. So if you go to infinitebanking.org, they're actually listed for North America. So you can actually select by state or province that you live in. And the reason I would recommend that is simply because not all whole life insurance products are created the same. And you want to make sure that you get the benefits that we've talked about today. Like that's really, really important because you want to make sure it's properly structured. And people who've gone through the authorized infinite banking practitioner program have done that additional training and have been mentored. So you can have confidence that they have learned how to structure these policies correctly to give you the results that we've spoken about today. Um, I would also encourage you that anybody that you work with, please do ask them about their own policies. So, something that I learned from the investing world is if somebody thinks it's a good idea and they're not doing it themselves, but they're teaching it, you have to question it. So,
Yeah.
like, people need to, if they believe it's a good idea, like I implemented it in my own life first before I started teaching it because I wanted to see it work. I wanted to make sure it worked. And I'm more than happy to share with people about what I'm doing because I think that's a really important part of this as well. And your advisor will continue to work with you and coach you on this process. So while we've talked about the product, we've talked about the features of the product, again, it's just a bucket, it's just a storage. But how you use that and the process that you go through to use that is actually going to make the biggest difference to your results. And somebody who you're working with in this process is what's going to help you make, use this product in the way that it was designed to be used and give you the results that you want to. Plus, life changes and shifts. And so having somebody that you can speak to about how to adapt to those shifts without doing anything that's going to prevent that compounding of your policy is really, really important. So, and you should be able to work with people on an ongoing basis. And so they should offer that to you as well. So it's not just set up and then figure it out on your own. So what else should you do? Well, you should get started as soon as possible. And why is that? Because of the benefits of uninterrupted compounding, right? That takes time. And so when's the best time to plant a tree? Well, 20 years ago.
Yeah.
The next best time is today, right?
Yeah, I mean, again, I mean, there's a lot of literature on this, and because I have a passion for this, there's actually an author called Wade Pfau. He's a retirement kind of planning expert in the US, and he's written a few books on annuities, insurance products, traditional investing, and so on. And it's very interesting because the benefits of uninterrupted compounding happen around like the year 12 to 13. Um, and then it's kind of like an inflection point at that time. And it's very interesting because if you look at most of human history, most of the literature, majority of the time we're changing our strategy every 5 years, maybe every 8 years. I mean, as part of the course, I was doing some research. The average Canadian apparently changes their house every 5 to 7 years. I
Mm-hmm.
mean, this is if this is the one of the largest single purchase in your life, you're changing it every 5 to 7 years, and that's the average Canadian. So it is very interesting on the benefits of uninterrupted compounding and to know where the inflection point is, and it's definitely in after a decade. It's after a decade, not immediate for sure.
Mm-hmm. Yeah, for sure. So if you want to reach out to connect with me, that's a link to my Calendly. You're welcome to scan that QR code and you'll be able to book directly in to connect with me.
Perfect. Yeah. Like, I mean, thanks a lot, Liz, for coming onto this, video series. We covered a lot today on, um, topics of power whole life, specifically with a corporate policy. This video is not meant to make you an expert. It's actually to make you curious, because that's what started my journey on this path. Is it made me curious to learn more about this information and actually instituting this philosophy into my life. And you had a very good point. Ask the person whether they've actually done what is being taught here. And so part of the reason why I wanted to do a collateral loan as well as a policy loan as well as a mutual company and a stock company was to get to get experience with these various kind of strategies, um, and instituting it myself before others from my own family institute it in the future. Because if this has been there since the 1870s, I don't think this is going to go away in 2070s or even more. And so it's important for people to know that. So thank you for taking your time. I know that we wanted to make this an hour webinar, but I think most webinars are going to 2 hours. But I'm sure that this is valuable to the listeners.
Thanks so much, Drew.